I think I'm having poor connection. So if okay, start. Everyone can see.
Yeah, can see Jaya.
Okay, I think the recording is just about to start. I think I may start the presentation. Okay.
Okay.
Good evening to everyone, my fellow group member and lecturer. Uh, we are going to do a video recording presenting about analysis of financial statement, which our main company is Padini, and we compare with the Parkson. Myself, Jayalashmi, and my fellow friends, Krisha and Soundarya. Okay, now I'm moving to the second slide. Okay, Padini is about the industry, a company doing retailer business. Same goes to Parkson. They're also doing retailing, which is domestic in Malaysia and abroad. There is a different business which is Padini also other than retailing. They are doing distribution. In a while, Pakistan also doing other than retailing, such as like property. Just their business. And now I'm going to move and next slide. Okay, now I think you may all can see the slide about the Padini Holdings Sandra Berhad vertical analysis, which I do the vertical analysis based on the statement of the profit and loss for the year 2017, 18, and 19. Here you all can see when we do the vertical analysis for the statement of profit and loss revenue, as you all know, the percentage will be the 100% for all of the year. So the rest of the item will be the different percentage. As you all can see, for the cost of sale, for the 2017 is about 61, and then the following year is to slightly decrease and back to the actual figure for the year 2017, which is 61. So we can see the cost of sale usually we use to produce the goods or service. So here we can see the revenue is increased every year, and also the same cost of sales, which is we spend the expenses to produce the goods also increase. So I think they manage efficiently the good of sale, which is they provide good revenue. Next is the selling administrative expenses, which is you can see the expenses is increased by the year, and also the administrative expenses is increased, which is we can see the percentage is remain same, and there is also slight increase like 22 in the year 2017, and the increase in 2018 is about 23 percentage, but the expenses is remain in stable condition, which is they are maintain their expenses, which produce the outcome is very good. They are maintaining very good revenue for the Padini Holdings and number 5. Profit for the year, as we can see, there is an increase from the year 2017 to 2018, and there is a slightly decrease on 2019. This is maybe of the pandemic of COVID-19, and there is the all of the percentage has been shown here. The difference by the year 2017, 18, and 19. Uh, Next slide, I'm going to talk about Parkson Holding Berhad. They also doing the retailing. The statement of profit and loss, vertical analysis. As I mentioned before, the revenue is 100%. Okay, now we talk about the item of expenses. Okay, what is that item of expenses? Is actually the COGS of the company. We can see they spend more on their COGS, the item of expenses, which is can we say the amount they spend on the expenses, but the outcome for the revenue is not efficient. Like what they spend, but the return is very less, as we can see here. And also the operating profit is decreased, which is we can see the severe decrease on 2017 to 2018. The decrease is very sharp drop, and for the 2019, there is a slight increase, but compared to the 2017, is a big loss. Even though they are earning profit, but is for the company is a very hard to manage the for best outcome. And also the profit for the year, as we can see, there is the increase on 2017 to 2018, which is 3 percentage to 4 percentage. It can be a slight increase on their profit and profit for the year. And for the 2019 is a decrease, but still the percentage is 4 percentage. Next, next is about the horizontal analysis. But before I move to the horizontal analysis, I'm just explain the comparison, which is from based on the vertical analysis for the Padini and the Parkson. We can clearly see that Padini is very good managing their expenses, which is what they are spent. The outcome is consistent, efficient. But compared to Parkson, they spend more, but the outcome, the revenue is very less. Okay, now it's about the horizontal. Horizontal, as we all know, this is the how we get the horizontal is based on the current year minus the base year over base year times 100%. Here we can see the revenue is about, we can see there is a decrease on the revenue, which is in 2017 Padini have good sales, and there is also increase, but the percentage is not showing good because uh, the increase is not a very efficiency, and the cost of the sales is still same. They are spending very efficiently, and they are earn what they are spend. They earn is a very good outcome. As we can see, the selling administrative expenses all incurred to produce the goods. They're spending very efficiently to get the produce the revenue.
Jaya? Jaya?
Soundarya,
Hello,
is there Jaya in line?
Jaya in the line. Sorry,
Okay,
there's an
sorry.
internet problem.
Yeah. Sorry. Sorry. I have a network problem. That's why. I
Okay.
think may I continue? Now we are on the. Lastly, I stop at the horizontal, isn't it?
Yeah, you all can see the slide.
Hello. Please change to the horizontal side, Soundarya.
This one?
Last I stop at the horizontal. So shall I continue?
Yeah, you all can see the slide. Padini
Now I see
horizontal
the vertical
analysis.
analysis.
Krisha, you can see the slide.
Uh, yeah, I can see the horizontal for Parkson because lastly I stopped horizontal for. Uh, okay, now I okay now you all can see the okay. Uh, as I mentioned lastly about the Padini, based on the horizontal analysis, profit for the year they are doing the better outcome. As we can see, the percentage is remaining stable, which is they are doing efficiency operation. Next is about the cash flow analysis. Everyone can see the cash flow analysis. Can see.
Soundarya changed it. Yeah, okay.
Soundarya, Krisha.
Yeah, okay. You continue, Jaya.
We already
Hello.
changed the slide, Jaya.
Okay, can see. Okay, now I'm going to talk about the analysis. Okay. Now I'm going to. Okay. Now I'm going to present about the cash flow analysis for the company Padini Holdings India Berhad, which is as all you can see, there is analysis for 3 years, 2017, 18, 19. I first explained about 2017, which is in 2017, Padini was on maturity level because they are receiving positive cash flow from their operating and investing activity, and they are spending very less on their financial activity compared to the following years, as well as like 2018 and 19. And also for the 2018, the company cash flow on average rate, which we can see, they more spend on their financing. The amount is about 123,000 and 73,000, which is they are spent more on their financing compared to the previous year. And then there is a reduction on their operating activity, and also operating activity and investing activity compared to the previous year, and they are spend more cash on their why their investing is very less, because when we see the 2018 they're receiving more, but 2018 is very less because during the year 2018 they use the cash on financial investing activity, which is they are used for placement of unit trust fund and purchase of assets and sell their unit trust on the same year. For the 2019, the company has a very limited cash flow from their operating activity compared to the past 2 years, because past 2 years the outcome is very good compared to 2019. Uh, Compared to past 2 years, now the company spend on their investing, such as purchase of assets, and followed by that they are spent in their financing, which is they are spent to pay their borrowing obligation. The followed by that, I'm going to explain the statement of cash flow analysis for the Parkson. Parkson, we can see. Firstly, I will explain the 2017. 2017, we can see that they were on the decline stage, because even though they have outflow from the operating activity, but when we see the investing and financing, they are more spent on their investing and financing side, which is such as what their investing activity during the 2017 is they purchase of the asset and investing security and deposit for financial activity. So they are for the financial activity, they pay the borrowing obligation. So for investing and financial activity, they spend more compared to the operating activity. And for the 2018, the company can be said was a stable condition because even though the operating is very less, but they are investing, they earn from the investing because during the 2017 they are spent to money to purchase the security deposit in bank, so they earn from the investing. And for the 2000 what cash flow from the financial activity for 2018 is very less compared to the 2017 and 2019. It can be said there is a slightly increase in their operating activity, which is uh, compared to the previous years, there is a very less, but there is a slightly increase. Moreover, they again slight reduction on their investing because 2018 they earn good on their from their investing activity, but 2019 there is a slight reduction, and also from the financial activity there is a slight higher compared to 2018. They spend a little bit more during the 2019, which is they are using to pay their obligations such as the short-term borrowing loans. Is next about the um, I'm going to explain about the equity, current ratio equity. Everyone can see the slide. Analysis of financial statement, return on equity. Okay. First, I'm going to talk about the Padini Holdings Berhad. We can see 2017 is 28%, and the following year 2017 and 2019 is 22. Usually, return on equity is a very stable condition, which is when the percentage is about 10 to 20 percentage. It can be said the company is okay, good condition. They can continue to do the operation. But here we can see for the Pradini Holdings, they are doing a very successful business, which is they are generate more cash. And the investor also, when investor want to invest in their company, they have been looking the return on the equity, which is the company can grow with the good outcome, and they have a better benchmark to compare company return on equity, which is it's the industry average. Generally, high ratio is better company is. So as we can say, there is a decrease on their current ratio, sorry, on their return on equity, but there is a not bad because 2018 is a very good. 27 22 percentage is considered is a very good too for the Parkson. Okay, Parkson, just now I mentioned for the return on equity should be the 10 to 20 is a better, but here we can see the Parkson, they already have the negative on their return on equity, which is 432. It's mean the company is not successfully running, they are not generate cash, which is the company incur loss, the no netcome, their company already in negative. This is me the investor not interest to make invest in Parkson and Padini. As we choose the analysis of a financial statement as a corporate controller, we will look into the return on equity, which is support uh, to make the analysis when we are as a corporate controller. Next is about the analysis about earning per share. Earning per shares for the Padini, we can see they have a good earning per share, which is for the 2017 to 2019. Even though there is a decrease or increase, but they are still maintaining a good earning price, which is what we can say is um, earning per earning per share is determine the company yes, determine the company good sign of growth. So we can see that there is a good sign of growth. They perform consistently very efficient. But when comes to Parkson Holding, they have a negative earning per share, which means they are not growing. This is not a good sign. It's a bad sign. They're not doing their business efficiently. It's maybe because of the pandemic. For the 2017-18, it's because of they're not performing well. Maybe 2008-19 is because of the pandemic COVID-19. Next slide is my fellow friend will present. Continue, please.
Okay, hello, I'm Soundria. I'm going to present about the profitable ratio of Parkson Holding and then Padini Holding Berhad. Okay, what is the profitable ratio? Profitable ratio is the class of the financial metric that are the used to assess a business ability to generate relative to its revenue, operating cost, balance sheets, asset, and shareholder equity over time using data from specific point in time. Profitability ratio also are the set of measurement used to determine the ability of business to create earning. There's a three types of profitable ratio. First is gross profit margin, second net profit margin, third one is a return on investment. Okay. First of all, let me explain about the Padini Holding Berhad profitable ratio. The first one is gross profit margin. The formula for the gross profit margin is gross profit divided by revenue. For 2017, the gross profit margin are 39.38%. For 2018, 40.95%, and 2019 is 39.14%. Okay, the second one is net profit margin. The formula are net profit divided by revenue. The result for the 2017, the 13.57% and the 2018, 10.61% and 2019 also 8.98%. The third one is return on investment. The formula net profit divided by cost of investment. The result for 2017 is 19.68%. For 2018, 19.28%. For 2019, 16.76%. Okay, we can see the gross profit margin. As a corporate controller, the comparison is from the 2017 to 2018, the gross profit margin for the business increased from 39.38% to 40.95%. But in 2019, the business was decreased to 39.14%, which means the business is getting worse to controlling the cost of goods sold. And then the net profit margin, between the period of 2017 to 2019, the net profit margin has decreased from 13.57% to 8.98%, which means the Padini Holding business is getting worse to controlling the expenses. The third is return on investment. As a corporate controller, we can see a positive result of 19.68% in 2017, means that return exit cost analysis therefore considered the investment is a net again in 2018 is 19.28%, and the same goes 2019, the return on investment is 16.76%. We can see there is a decreasement. Return on investment is in 2017 is better than 2018 and 19 for the Padini Holdings Berhad. Okay, the second one is Parkson. Okay, for the Parkson, the profitable ratio in 2017, the result was loss negative 3.57% and 2018 0.09% and 2019 2.21%. For the net profit margin in 2017, the negative 2.86 ringgit, the 2018 4.26 ringgit, and the 2019 3 ringgit 78 cent. Okay, for the return on investment, Parkson 2017 was 21.59% and 2018 26.16%, and the 2019 is 25.98%. We can see the gross profit margin of the Parkson. The comparison from 2017 to 2018, the gross profit margin for the business slightly increased from negative 3.57% to 0.09%, and it continuously increased in 2019 to 2.21%, which means the Parkson business is getting better to controlling the cost of goods sold. The second one is net profit margin. We can see here that between the period from 2018 to 2019, the net profit margin result as negative, which is 2.86%. and then 4.26 percentage, and also 2019 3.78 percentage show that the business is getting worse to controlling the all expenses of Parkson. The third one is return on investment. We can see here for the Parkson in 2019 for 2017, for every 100 ringgit investment in asset, the return is 21 ringgit 59. For the 2018, for every 100 ringgit investment in asset, the return is negative 26.16 cent. In 2019, for every 100 investment in asset, the return is 25.98. The return on investment show a negative result for the 3 year, which is 21.59 and negative 26.16, and 2019 is 25.98. So it's mean that the Parkson business financially lost. In other words, the business lost more money that it brings in, experience a net loss. Thus, the return of investment in 3 years is not better if we compare to the Padini holdings per head. Okay. Next, Krisha.
Hi everyone, my name is Krisha. I'm going to present about liquidity ratio. Liquidity ratio is an important class of financial metric used to determine the debtor ability to pay off current debt obligation without raising internal capital. There is two types of liquidity ratio, which is current ratio and asset test ratio. Okay, we are going to see for the Padini first. Current ratio is the simplest liquidity ratio to calculate and interpret. So the formula of the current ratio is current asset divided by the current liabilities. For the 2017, the answer is 2.3 times, and 2018 is 2.93 times, and 2019 is 3.92 times. So it shows it's slightly increased by year to year. And the asset test ratio is the formula of asset test ratio is current asset minus inventory and divide by the current liabilities. For your info, asset test ratio compares a company's most short-term asset to its most short-term liabilities to see that a company has enough cash to pay its immediate liabilities. Here, the answer for the 2017 is 1.68 times, and in 2018 is 1.90 times, and in 2019 is 2.54 times. So it also showed that it slightly increased year to year. As a conclusion, current ratio must be greater than 1.0 in order for the entity to the in great position to pay off its liabilities. The current ratio for 2017 is 2.33, and for 2018 is 2.93. It shows that the Padini is able to pay off its liabilities. There is an increasement in the current ratio. Ratio for 2019 is 3.92, thus it shows that Padini is in a better position to pay off its liabilities in 2019 rather than 2017 and 2018. Second, for the acid test ratio, both acid test ratio shows that Padini has enough current asset to cover its current liabilities. In 2017 and 2018, for every RM1 of current liability, Padini has RM 1.68 and 19 of quick asset to pay for it, while in 2019, every one of current liability, Padini has 2.54 of quick asset to pay for it. Thus, the asset test ratio in 2019 is better than the asset test ratio in 2017 and 2019. As a conclusion, for the liquidity ratio for the Padini is slightly increased and show a better result. The second is for the Parkson. Liquidity ratio, the first current ratio for the Parkson is in 2017 is 0.88 times, which is lower than 1. And in 2018 is 1.18 times. And 2019 is 1.32 times. So you also we can see that for Parkson it slightly increased from the year 2017 to 2019. The second acid test ratio results show as 0.80 times for 2017, which is means not good also. And in 2018, it shows 1.04 times. and in 2019 is 1.145 times. So here also it increased slowly from 2017 to 2019, which shows that in just in 2017 only, both for both ratio is less than 1. Soundanya, Soundanya, change the slide, please.
Which slide, Riksha? Current ratio 1.
I cannot see.
You can see or not? The slide.
No, I cannot see the slide.
Jai, you can see the slide.
Okay. Okay, I continue here. Okay, when we compare, the current ratio must be greater than 1.0 in order for the entity to be in great position to pay off its liabilities. The current ratio for year
I see
2017 is
current
0.88.
ratio.
Year 2018 is 1.1 and year 2019 is 1.32. It shows that the person is able to pay off its liabilities. There is an increase in the current ratio, increase from 2017 to 2019, which is from 0.88 to 1.32. Thus, it showed that the person is in a better position to pay off its liabilities in 2019 rather than 2017 and 2018. For the asset test ratio, Parkson has enough current asset to cover its current liabilities in 2017 because for every RM1 of current liability, Parkson has 80 cents of free asset to pay for it, and it's not a better result. Why? In 2018, for every RM1 of current liability, Parkson has RM1.04 of free asset to pay for it. Then in 2019, for every RM1 of current liability, Parkson has RM1.15 of fixed asset to pay for it. Thus, the asset test ratio in 2019 is better than the asset test ratio in 2017 and 2018. Overall, it slightly increased from 2017 to 2019. Next is I'm going to present about the efficiency ratio. The efficiency ratio, which is typically used to analyze how well a company uses its asset and liabilities internally. Under efficiency ratio, we can calculate the inventory turnover ratio and average collection period. So first is inventory turnover ratio. This ratio measure how efficiency a company use its asset to generate revenues and its ability to manage those assets. Okay, you can see the Padini holdings. For the Padini holdings, the result show as 4.05 times in 2017 and in 2018 is 4.4 and 2019 is 4.06 times. Even it's slightly increase from 2017 to 18 it's increased, but still decreased but not that much. For the average collection period, in 2017 is 15 days and in 2018 is 12 days and 2019 also remains same. So it's mean the ability to collect the debt is still remain and so better. 2019 also company will able to restock their inventory 4 times in one accounting period in every 3 months. Padini orders Bharat takes 4 times to convert the inventory to sold product for both years, 2017 and 2019. It will convert the inventory for every 3 months. Okay, for the average collection period for 2019, the company will able to make collection from their credit customer within 12 days because in 2017 so 15 days it take longer than in 2019, so it's considered better. So next, for the Parkson, the results show as 3.6 times in 2017 and 4.5 times in 2018 and 5.0 times in 2019. And for the average collection period, in 2017, it's take 46 days, and in 2018, 50 days, and 2019 is 52 days. It's considered it's not a good result because it's slightly the days increase by day to day. Okay. Uh, when we compare, Parkson takes 3 times to convert the inventory to sold product for the year 2017. In 2018, takes 4 times to convert the inventory to sold and takes 5 times to convert the inventory to sold the product for the year 2018. It will convert the inventory for every 3 months. For the average collection period for the company in 2019, the company will able to make collection from the credit customer within 52 days. It's considered not too good. So as a corporate controller, overall of the comparison between the Padini Holdings, Berhad and Parkson, based on the above calculation, we can see that the result of Padini is better than Parkson because both efficiency ratio of Padini is better if we do comparison. As a comparison for Padini, overall of the profitability ratio is that the ratio 2017 is better than ratio 2018 and 2019. Liquidity ratio for overall of the liquidity ratio is that the ratio 2019 is better than ratio 2018 and 2019. Efficiency ratio also the for both year and remain the same. As a conclusion for Pakistan, the overall of the profitability ratio, it shows that the ratio in year 2019 is better than ratio in 2017 and 2018. Liquidity ratio for overall of the liquidity shows that the ratio in year 2019 is better than ratio 2017 and 2018. And the final one is efficiency ratio. The overall of the efficiency ratio, it shows that the ratio in 2017 is better than ratio 2018 and 2019. When we do comparison between the Padini and Pakistan, as a corporate controller, we can conclude as the Padini shows the better result if compared to the Pakistan. Okay, that's all from our company. That's all from our group. Thank you.
Thank you, everyone. So here we stop our presentation. Thank you all.
Thank you.